Hi, this is Jim Freed, the host of Freed on Business on 880 AM The Biz in Miami, and you're listening to the U.S. Family Office Realestate.com podcast. The podcast provides you real estate information designed specifically for family offices. Make sure you check out USFamilyOfficeRealestate.com for educational information for family offices, including white papers, fact sheets, videos, and podcasts. You'll also find information on specific markets and assets, real estate cycles, tax-efficient real estate investing ideas, and much, much more. That's USFamilyOfficeRealestate.com. Information for family offices by a family office.
Hello, this is Richard Wilson from the Family Office Club, and welcome to this episode of our Family Office podcast. We're doing an expert audio interview with DJ Van Keuren from the Arsenal Family Office, and welcome to the call, DJ.
Thanks, Richard.
So DJ's actually spoken at one of our events. I also saw him at a family office kind of networking session recently because he was, I think, speaking at another event. And in short, he runs a real estate-focused, or helps run a real estate-focused single-family office. And I thought it'd be great to have him here for an interview just to talk about what he's seen in the space right now and how families are adjusting their portfolios and what are the biggest trends going on in the industry, and if somebody wants to work with family offices that are focused on real estate, maybe some of the do's and don'ts of that. So is there anything else you want to clarify, DJ, on kind of what you do every day at Arsenal?
Yeah, no, that's, we are a single-family office, just like you said, and located in Boulder, and our patriarch, his story is he sold a yogurt company about 30 years ago for about $1 million. He's turned that into about $500 million. He's done that all through real estate, and up until about 6 or 7 months ago, it had been his capital along with about 15 friends and family. So as we're going through a progression, as many family offices do, separating out the operating component from the family office because they're all in one, we started a mandate to become part of the family office community. So as of last October, I've been heavily entrenched in the family office, going to your conference, a number of the other conferences that focuses on family offices, and really making it a point to maximize the times that I'm there. So I have been fortunate to I believe, meet probably about, believe it or not, about 300 families or so over the last 6 months, and really discuss not only what we're doing, but also to get an idea of what some other families are doing, and depending on where they're at in their evolutionary process. Sure.
And I know right now that even though markets might still be trending upwards, in some places are a bit more soft, and families are being a little bit more defensive, or at least talking about what they might do to be defensive. I mean, how much are you seeing that out there? Well, talking to 300 families, would you say 10 or 20% are getting pretty defensive and the rest are still relatively bullish, or what do you think the consensus is out there?
And well, I'll tell you, we were actually just talking with our patriarch here, and he was talking about the real estate market, because that's where our focus is. Although we do have investments in other areas, just like other families, whether it's oil and gas or individual issues or private equity, hedge funds, etc. And
Sure.
the biggest thing that I think that's out there is that there is a defensive posture in many regards. I think that the family offices right now are a little concerned about interest rates, what's happening in the economy or what's going to happen. And just yesterday, actually, I sent out a survey to a number of the families that we've been getting to know, and I asked just 2 questions, and one of them, which got the biggest response back, was trying to understand where are we in the real estate cycle, right? What's happening and what's going on in the marketplace, and that relates not only just to real estate, but that's in other areas as well. So there's definitely, I guess, a little bit of a pause and a concern that's currently happening in the market.
Right. Yeah, I've seen that too. I mean, some people think it might be 18 months or 3 years away, and might not be till 2019 that something turns down. But the truth is, everyone admits that nobody knows, and sometimes with all the global volatility that's been going on, some people are just trying to be very cash focused, and then others are saying, well, as long as it keeps on trending upwards, we're just going to only say yes to the deals that we truly understand and could navigate and wait out, even if the market goes down. It's an area of New York or Miami that over 7 or 10 years it will go back up to a record high, even if it gets dipped on us. And that's life, and we just have to only go into investments where they think that is the case, is where I'm hearing from some families. But also want to talk about club deals and co-investments. Is something we talked about at that cocktail hour at the Mandarin, and about what trends you're seeing and talking to these families, because there's groups out there, there's private equity funds with a blind pool and you pay the fees. There's sponsors that just take like a waterfall promote, which is hugely popular in the real estate space. So at least you know what you're getting into, but then you have to pay a promote. And while sometimes it can be a great business, and sometimes for an investor at 10 or 20 million net worth, or even 100 million net worth, if they're not real estate guys, it could make sense. What I find, and I think I shared with you, is that a lot of $100 million plus savvy real estate guys are like, why would I let someone else use my capital? Well, they put up almost nothing, and then they get 30% or 25% of the profits. Like, you just hire a $500,000 a year guy and keep 100% of the profits. If you're worth 100 million plus, you have that optionality. If you're worth 10 million, you don't. And I just wonder what's the feeling out there, and like, how do families who are savvy and a little bit sensitive to fees, how do they approach these co-investments and club deals? And how often are they paying like a promote to get that type of work done? Because someone has to organize that, and someone has to do diligence the deal and find it and work it out and get the debt and spend a lot of time on it.
Well, I think, and this goes across the board, obviously my focus has really been talking real estate with other people, but while I'm talking to other families, we're also looking for opportunities outside of real estate from a diversification perspective. And there's a couple different things that it seems to be a common theme that keeps coming up over and over again. And the one is that the single family offices, they don't necessarily have the bandwidth internally to do the analysis and to understand, to really dig into deals on a deal-by-deal basis. And so because of that, a lot of them will look to funds, and they'll figure, okay, I put it in a fund, it's pooled, and somebody's expertly managing that. If they want to go into direct deals, even though they don't have the ability to do the evaluation on the opportunity itself, whether it's real estate or private equity, then if they're going to look to partner with somebody, then that question comes to is, okay, how do we do our due diligence on the operator so that we know we've got a good partner? And so because of that, that is why they go toward the funds. But then the common theme that continues to come up as well, which I know that you hear all the time, is fees, right? Because a lot of the families are concerned about fees, and especially a lot of the larger organizations, whether it's the Goldmans or whatnot. I mean, there's definitely fees that are involved. And so one of the trends that seems to me that I've been seeing is actually partnering with other families and that has an expertise in that space. And that is something that to me makes an awful lot of sense. In fact, I was talking to our patriarch because he's very bullish on oil and gas, and one of the things that our family is a little bit different, I think, than the other families is that we're really controlled by the macro analysis, and so we'll look at trends and we'll do a lot of the economic understanding of the various markets, and of course oil's down, and so he's bullish on that. And what I said is, why not go with somebody? We should really be looking for a family that's where they made their wealth, right? And same thing in if you're looking into healthcare. Well, guess what? There's family offices that made their money in healthcare or technology or hedge funds, right? And so it seems to me that families are looking for something similar, more more and more to, an expert in that specific field. And that's a trend that seems to me will continue to go, because there's also a level of comfortability with other families understanding and having a principal mindset, truly a principal mindset. Back to the comment you made about, okay, I'm giving all this money, they're getting 30% for nothing to be contributed. Where if it's a family office, they're writing the check and they're right next, they're putting their money right next to you, but also, well, they've had a successful track record, and so that adds comfort as well.
Yeah, for sure. Yeah, I think it does add a ton of comfort. And also I think as the fund management space gets more competitive and you're competing with sponsors and direct investments, it's going to force down that management fee and make the performance fee more, reasonable. And I could definitely see some family offices or some fund managers that are just well-equipped with a nice capital base or an operating business in the space saying, we're not going to be greedy. We're just going to charge, 10% performance fee, no management fee, and transparent deal by deal, et cetera, because I see it as like a compromise between ridiculous waterfalls, management fees, even on an investment that's losing money. And I don't know, I see some trends like leading towards a slimmer and slimmer management fee. And I think what's comical is, like, no matter who I talk to, everybody tells me that their fees are market, even if they're saying, oh yeah, and after 17%, we split the profits 50-50, and just like it's totally not market, but everyone will tell you that. So as a warning to families, definitely you got to do your homework and figure out what the real market is and know that just about everything is negotiable. And also, I think it's interesting just seeing, the different track records of firms versus the fees they charge. They're definitely not always aligned the way you think they would. Some of the old firms have been around for 30 years, charge less of a waterfall. So I think it's kind of interesting seeing that out there.
Well, I'll tell you, it's if you talk to any family office and if they're just going to go plain vanilla and said, okay, Richard, we're putting in 50%, you put in 50%, but if you're managing that project or that opportunity, no family office is going to disagree with sharing in the cost or making sure that the cost for that investment is being taken care of. Where the concern comes in when it's like, okay, yeah, we're paying for the cost, but you've got a profit center there that's pretty significant, and especially when you look at some of the funds, and if they raise $2, $3, $4 million and $400 million, and 1%, and they're generating $3 million annually, does it really cost $3 million to run that office? That's where I think the concerns come in for that.
For sure.
That's. But they're never going to say you need to take a loss in your expenses because of what you're doing. So I think it's just something that, for people that are structuring with family offices or family offices that are looking to work with an operator or whatnot, they understand, and you need to understand that we've got to pay our overhead. The question is that being extraordinary, is it above and beyond to a point where what you just said recently, that you're making money regardless of what happens to the performance.
Right. Yeah, for sure. Another trick I think it's easy to miss for investors I've seen is that it's different with every sponsor, but what I found is some will say, oh yeah, you get an 8% preferred, which sounds great up front, but then the next sentence is like, oh, and then we get a catch-up. And sometimes that means and then they get an 8% return, and they get to get that return. Sometimes they get to catch up in terms of the 20% start of the waterfall, but sometimes it means literally you're essentially, sharing the fees down the middle on the first 8% and then going to a 20. So I think there's a lot of terms that investors have to be really careful with, and family offices do. If they're getting started in this space, they really need to read every word and understand every calculation, because you might pay 30% more fees than the family office next to you just because it's your first or second or third investment, I think.
Yeah, and it's two things I want to bring up on that. I was talking with a local family here who, like many family offices, single family office, then another family wanted to come in, and 5 years later, here they have 25 different families, right? And they were talking about they were working with one of the large wirehouses that was managing the money, and they sat down and they did an analysis of okay, so let's do a portfolio review, and they had a number of investments they were using, and 65% of those investments were in their funds, right, in their proprietary products. And the family office said, okay, so let me ask you a question. If there's another opportunity that is similar to your fund, but they have a better track record, lower expenses, better performance, does that mean that you're going to take the money out of your proprietary product and put it into, where it's best to go? And there's nothing that wirehouse could say. They were like, well, but we have great performance, and
right.
There was a tremendous amount of fees, and it wasn't even being, they weren't really even being open, what I think, to the best interest of the family. So you also have to be aware of that, because there's a lot of great companies, but they have their own products, or it's proprietary in the point where those fees are a lot more than you realize.
Yeah, we're trying to develop a tool right now to help families in assessing some of that, which we're kind of excited about, but it's still a work in progress. I love that you brought that up. I don't think anyone's ever brought that up on our podcast, and it's funny watching like the turf wars of private banks, and then they'll create their family office white paper, or they will create their family office hub in their private bank, and it's like, reality is family offices are eating the lunch of private banks, and they exist because private banks abuse their clients with proprietary products, high fees, conflicted interests, and not holistic service. That's not always the case. There's some great private banks and trust companies out there, of course. There's always a spectrum in anything, but family offices wouldn't exist if private banks had a fully holistic service. Then that would be the definition of a private bank. It wouldn't be the definition of a family office, because it would mean one and the same, and the trend wouldn't be catching on like it is. But I'm glad you brought that up. Thanks for mentioning that. In
fact, one of a good friend of mine, he was working at a private bank, private client group, and he'd been there 4 or 5 years, and he had decided to say, look, I'm going to branch out, and went down the RIA route, which with high net worth people. And I get a phone call from him about a week or two later, because he was following up with some of his old clients. And he goes, DJ, I didn't realize how expensive, some of these products that had been putting his clients into. And,
right.
And I don't take that away from him. I mean, he was employed by that private bank, but the point being is that when he really stepped back, he was like, holy cow. And, some of the clients either didn't realize that, or even when he made them aware of it, they didn't say anything because they felt that the reputation or the size of that private bank was important to them. But if you are really looking and digging down, you're going to find much more layers and layers, that are involved in some of these investments. And we're just starting to have other families invest with us. And he opened that up, and just 2 months ago, we have a couple families that we've said, okay, we're going to open up what we do and provide those opportunities, because since '98 alone, our family office has averaged about a 32% IRR on over 200 deals, which puts him in, among the best in class when you look at it on a national basis. And our relationships and what we're doing, we're only going to have a limited number of families, but it's full transparency. Fees are just to cover the basics, and we're not splitting it down the middle to say, hey, we'll just go 50-50. We actually are giving them pref returns and ability to get up to a 15 before that even happens. And so we're sort of we've taken that philosophy to say, okay, we're going to take sort of that return opportunities that some institutions do, but we're going to have this as plain vanilla and clean as possible for the other families so that we do have that full transparency. And there seems to be a lot of, that's something that I think families enjoy and they respect. And as to what you were saying before, I think you're going to start seeing that more and more over time, especially as the family office market continues to grow and expand, which I know firsthand you've seen that for the amount of time that you've been in the space.
Right. Yeah, for sure. I mean, I think some people listening to this are trying to figure out, it's challenging getting the contact details of a single family office, trying to get one that's focused on real estate. Okay, great. Maybe they're interested in my development property. But then the reality is anyone who's really good at investing in a niche and they have many operating businesses there are just going to get requests over and over again for people to invest alongside them or invest with them. And then it encourages, accepting money from outside families. So what would you say to those listening that were thinking like, oh, great, I can't wait to, show DJ what we're doing because it's like a mind-blowing real estate transaction we have going right now. And then they hear that you guys are, looking to work with other families and might be like, oh, dang, maybe they're only interested in like the other direction, not being like an allocator in the real estate space. I mean, what would you say to those people who are out there, and what advice could you give them on like navigating it so they can find the families who are the real estate allocators, and what could you share about just like understanding that dynamic? Because it's just like the natural progression of growing expertise and reputation in the niche that people are going to ask you for help. They're going to say, can we invest money through you? So it's not that it's a bad thing, but it's a reality in the space that happens. So what could you share about that?
Well, I guess from a couple different parts. I mean, we as a family, we do get requests and often on real estate opportunities and whatnot. Now, obviously, in the fund space, we don't invest into real estate funds because that's where our expertise is. But we do work with local operators, so which is very important because they've got that local on the market knowledge, and so we are consistently open to opportunities that may be available from a real estate perspective. The one thing for us anyway, when that happens, or if somebody brought us a deal, the first question out of my mouth is okay, our patriarch has to get at least a 25% IRR. So is this project allowing for that? So that wipes out a lot of opportunities. In fact, I got one this morning, and they're like, "Oh yeah, we've been averaging 15-16%, and it's one of the best funds, on Preqin and all this other stuff." And I was like, "Well, unfortunately, our threshold's a little deeper, right?" So from that perspective, we are open, but we always invest where we have. We're part of the GP, for example. We don't invest as an LP, and the reason is because we have 95 people in our family office here, and so we've got 10 in legal, 15 in accounting. We have the full infrastructure for every single asset class across the board. Plus, we're in Spain and just bought a hotel in Puerto Rico. But for somebody that's looking to partner with a family office, it comes back down, and I think you can attest to this, is it's all about relationship. And, you hear that all the time in any industry that you're in, that you're trying to form some partnership. Relationship is the key. But, I was talking to somebody, a family office, and we were chatting on the phone, and he said something to me that was very, very interesting, and this was about 3 months ago, because I told him that, I'd been going to these conferences, and then I'm looking to go to these other ones, and I was going to be going to yours here in the next week or whatnot. And he said to me, he goes, "Good, it's good to see that you're serious about this, and that you're that you're sticking around, and that you're making a commitment to this space." And I think you see a lot of the same people at these conferences, as you know, and so you've got to put the time in. You've got to be out there. You've got to see people, and just by developing that, and I think too that's important is that don't make it all about what you're trying to pitch or what you're trying to do. I would try to go deeper into that relationship. And I was even meet with another family, and I wasn't talking about deals or whatever. We'd been in touch for 3-4 months. I met with him. We had lunch, and he literally said to me, DJ, what do we need to do? How can we work together? Well, he asked me that question, and that is, you've got to make a commitment to the space, and you've got to build that trust. It's my understanding, and tell me if I'm wrong though, but once you get that trust, families will talk about about you to other people if they're happy with how things are going.
Right, for sure. It's definitely the case. We have a capital raising workshop coming up. It's an 8-hour boot camp on how to work with family offices and positioning and everything that we do to build our investor relationships. Because 10 years ago I was on the other side raising capital and I didn't represent investors. And now, we don't raise capital. We found that our bottleneck was more the excellent deal flow that, we had the investors wanting to pay our fees. And the reason I bring that up is that we have a whole section of the event focused on how do you build trust, how do you create a referral network when you're starting from zero so it can feel like a chicken and egg, how do you provide genuine value but also show that you have authentic credibility that's kind of unquestionable. If you spend time, we spent 700 hours writing our single family office book and we sell it for $5 on Amazon, and there's no way to fake that because it's real interviews and videos and you getting on stage at our event and taking a question ad hoc from the audience and sharing some examples of how you guys have structured your investments, et cetera. It's real life. It's not just a quote in an article in the Wall Street Journal, which could mean anything, and you don't know who's behind that or if their company is real, et cetera. I find families really value that type of consistent credibility in the marketplace because they don't want to waste their time, and they're secretive, and everybody's hounding them for capital. So I'm glad that you brought that up. That was kind of, we didn't really plan out any questions for this interview, but you brought up a couple of things that are, very true to the DNA of the whole industry and just how we think about working with people in the industry. So I'm glad that happened without really planning out this call at all. We're just about out of time, but do you have a couple more points?
Yeah, I just want to take two more things. One is that,
sure.
You wrote a book which had to do with capital raising, I believe, in the hedge fund space.
Right.
And which you did years ago, and excellent book. In fact, I've looked at it a number of times. I even looked at it just a couple days ago, and a lot of the things that you talk about is very relevant, and you hit on a lot of great points. So, that's one resource that I think would be a great resource for people. And I understand, too, that this workshop you've got coming up is an extension of that goes into much greater details. And, it's something that is a resource and an opportunity I think people should definitely take advantage of. And the last thing I'll leave on here is that when it comes to family offices, and this took me about 4 or 5 months for me to understand this, just because somebody's worth $300 or $400 million and they made all their money in widgets, it doesn't mean that they understand or they can put their head around, for example, a hedge fund or some real estate structure or some other structure just because, yes, they're successful and they understand that, but also remember they've spent their whole life in the widget industry, so they don't understand it. And I didn't get that at first because one family office said that they had this event where they did Hedge Funds 101. I'm thinking to myself, come on, Hedge Funds 101, what are you talking about? But the reality is that they might not understand that, and you have to realize, so don't take that for advantage. And in fact, the best thing is this one family office, single family office I met with, he literally sold his business for $400 million. And when he gave me his card when I left, you'll never guess what it said. It had his name on it, and underneath his title was Investor in Training. And I thought that was awesome, and
yeah,
because he's still learning. And so being a resource, educating people, letting them know, being part of that process as you're disclosing your fees and where it goes to and what, so that they can understand. Don't assume, and take that extra effort to really, lack of a better word, hold their hand to have a good understanding.
Right. Yeah, that's a great point. And I think it's sometimes personalities get in the way of admitting that they're in training because they're like the titan of widget manufacturing, and now they're the infant of hedge fund investing. And many people don't wear that on the sleeve, and they're scared to ask questions. So it's important, if you are raising capital, to be very educational, just to be valuable, but also just to move up that learning curve so they don't have to ask what alpha means, or what some of these different strategy terms might mean. And we have a client who sold his business for $600 million, and then he called us and said, can you help me create my single family office and manage it? And he said the number one reason why he wanted help is that he wants to avoid the mistakes that he would otherwise have to make himself over the next 5 years and kind of skip all that pain and suffering. And I just think that for people on the side that are raising capital, being very educational and the most helpful, like aggressively, generously helpful in your niche area, pays dividends. And then on the investor side, just asking questions and realizing those being most helpful might also hold the more expertise and the long-term vision of actually working in the space. Like you going to all these events and meeting with 300 families versus someone who's just like, trying to meet a capital call or like trying to get one deal done. So they are just cold calling their Rolodex trying to close a deal. It's like a totally different approach than like how you're building relationships. I think that speaks to who the person is behind those actions,
Well, and you're a prime example. Because you've a lot of times people say, well, keep in touch with or do podcasts or videos or write a book, LinkedIn. Well, you actually do all of those things. So are you committed to what you're trying to accomplish in this space? And I think you're a great representation of that. And I know that I've tried to learn from that and replicate what you're doing. But it's extremely important because it does provide the education and the credibility as you move forward.
Right. Yeah, for sure it does. And the industry's big, and it's getting bigger every year. So there's, literally 100 different niches and slots where people could be known as the number one expert for, bridge loan financing, for real estate development of condos in South Florida, for New York, retirement home communities, et cetera. There's so many niches where you can be the number one most well-known person in the family office space for that one thing, so you can be kept top of mind by someone like yourself. So you can tap your brain on those 300 connections and say, oh, we're these two families, and all they wanted to do was assisted living, so why don't I help make the connection if that's clearly what you're trying to provide value to on the space. So I think that that's like a whole nother interview we could do at some point, maybe in 6 months or 9 months. We could catch up again on your travels and what you've been seeing in the space, and talk about one of these other 3 or 4 points you've kind of brought up ad hoc that I think could be a whole interview in itself, just on a niche topic perhaps.
Anything would happy to be of help if possible. But thank you so much. I appreciate the having us on your podcast and taking the time. It's been great.
Great. Yeah, well, keep in touch, and I'm sure I'll see you randomly at some family office event coming up. So it seems like we're in the same circles here. So until I see you again next time, thanks for your time today.
All right, appreciate it. Thanks, Richard.
Take care, DJ. Bye.
Bye.